Welcome, curious minds. Today we're embarking on another exciting exploration, custom tailored just for you.
Mm-hmm.
Our mission, like always, is to sift through the data and notes you've shared, pull out the key insights, and, well, help you get informed fast.
Sounds good.
We're tackling a really interesting piece today. It's analysis from Lucas Downey over at moneyflows.com, just published this week, July 24th, 2025.
Okay.
And the title grabs you, When the Fed Cuts Rates, Buy Small Cap Stocks. Pretty bold claim.
It is, yeah.
Yeah.
Suggests a specific strategy.
Exactly. So we're going to unpack that, look at the current market, think about why small caps might benefit, and then dive into some pretty compelling historical data he uses.
Indeed. And this analysis, it really focuses on a potential opportunity tied to, what the Fed might do next. We'll look at the logic, the history behind it.
Great. Okay, let's jump in. The source starts strong, saying extreme capitulation breeds extreme rallies, and that we're in a powerful broadening boom. What does that actually mean, this capitulation idea?
All right, so capitulation is basically when everyone throws in the towel. Just frantic selling, investors giving up,
Uh-huh.
often marks a bottom.
Okay, like peak pessimism.
Exactly.
Yeah.
And the idea here is, after that kind of washout, when money starts flowing back in,
Mm-hmm.
it doesn't just go to the biggest names, it spreads out. That's the broadening boom part, wider market participation.
And the numbers seem to back that up right now. The source mentions everything's been rising gigantically.
Yeah, the last month saw big jumps across the board. S&P 500, NASDAQ 100, the mid-cap 400, all up just over 4%.
But the small caps.
Yeah, the Russell 2000, that's the small cap index. It vaulted 5.64% in the same period.
So noticeably higher.
Definitely. It suggests a shift, and the analysis points to a few reasons.
Hmm.
Optimism on trade deals, inflation maybe not as bad as feared,
Right.
and this ongoing belief that AI benefits will, trickle down, boost efficiency everywhere.
And the source's own data, they tracked money flows, right? What did that show?
Well, that's interesting, too. In the past month, they say 83%, a huge chunk of the inflows they tracked, went into companies with market caps under $50 billion.
So not the mega caps getting all the new money.
Precisely. It's
Mhm.
flowing into small and mid-sized companies, and that's why their big money index, the BMI, which tracks this institutional buying,
Yeah.
it's been stuck in overbought territory for 30 straight days. Just shows really strong institutional conviction.
Okay, so the market's hot, it's broadening out, but the article says there's another big reason for this shift, especially into smaller names.
Yes, and this is the core of the argument, really. It's the anticipation of Fed interest rate cuts.
Right. The elephant in the room. What are the odds looking like now?
Well, as of this morning, the market's pricing in about a 66% chance of a cut in September. It moves around, of course.
Sure.
Fluid, but the quote they use from Alec Young sums it up. Rate cuts may be delayed, but they won't be denied. The general feeling is rates are heading down.
Okay, so connect the dots for us. Why would lower rates be especially good for small caps?
The main argument is that lower rates ease the financial pressure, particularly for companies that rely more on borrowing. Think smaller, growing companies.
More sensitive to borrowing costs.
Exactly. Lower rates mean cheaper debt, which can help their expansion plans, their profitability. It sort of loosens the financial constraints on them, maybe more so than for giant firms with huge cash reserves.
Makes sense. The author seems really bullish on this, talks about monster winning stocks this year, calls it one of the best stock picking environments in years.
Yeah, the tone is definitely optimistic. They mention new leadership emerging, lots of under-the-radar stocks, seeing heavy buying week after week.
Even says the good times are going to keep rolling, but, should we take that with a grain of salt? Are there risks here?
Absolutely. I mean, the whole thesis kind of rests on the economy not falling apart, right? If inflation suddenly spikes again and the Fed has to hold off on cuts or hike.
Or if we hit an unexpected recession.
Exactly.
Yeah.
Then the playbook changes completely. So it's a bullish outlook, but it's very conditional on the economy staying, reasonably healthy. You always have to watch the broader picture.
Right, context is key. Which brings us to the history part. Because rate cuts aren't always good news, are they? People point to the dot-com crash, the GFC.
Yeah, and that's a really important distinction the article makes. Those periods, like the late 90s, early 2000s or 2008, saw the Fed cutting rates because the economy was already in trouble or heading into a nasty recession.
Okay, so cuts during a downturn.
Right, and in those cases, stocks got hammered anyway. But this analysis looked back at times since 1991 where the Fed cut rates when the economy was actually okay.
Not in recession.
Not in recession then, and didn't fall into one within the next 12 months. Think like the 91-92 period after the Gulf War, or the mid-90s adjustments, or during the 98 global currency crisis.
So times when the economy was basically holding up and the Fed was easing policy, maybe preemptively or for other reasons.
Precisely. And the author argues that's more like today's environment, a relatively healthy economy potentially getting the stimulus of lower rates soon.
Okay, so that's the scenario they studied. What did the returns look like then, when the Fed cut rates into a healthy economy?
This is where it gets really interesting, especially for the small cap argument. The data they pulled shows pretty strong performance across the board, but with some key differences.
Let's hear it. Short term first, like 1-3 months after the first cut.
Okay, so 3 months later, the S&P 500 up about 5.7%, respectable. But the Russell 2000, the small caps, climbed 8.7%.
Ah, so immediate outperformance there.
Yeah, that's the pattern. Then you look out 6 months, Russell 2000 jumps 11.3%, and the NASDAQ, often seen as growth-oriented too, up 18.8%.
Wow, NASDAQ really taking off by then. And longer term, say a year.
12 months later, S&P 500 showing a solid 14.2% gain. Russell 2000 pops 17.1%, and the NASDAQ 100, a huge rally, up 33.5%.
That's a massive return for the NASDAQ.
It is. And then push it out to 24 months, 2 years later. The S&P 500 gains nearly 27%, the Russell 2000 surges over 36%, and the NASDAQ 100 ramps up almost 58%.
Incredible number. So the trend seems to be in the specific historical context that smaller caps and growth stocks tend to outperform significantly as time goes on after the initial cut.
That's what this particular study suggests, yes. It's important to remember, though, these returns don't include the 2024 cuts yet because 12 months haven't passed.
Good point.
And also the Russell 2000 is, it's a huge basket of stocks, 2,000 of them. These are averages. Individual stocks within that could do way better or worse. Some might, as the article says, violently surpass the average.
Sure, stock picking still matters. But the overall trend in these non-recessionary cut periods seems pretty clear from their data.
It does paint a compelling picture for that specific scenario.
Okay, so pulling this all together, what's the main takeaway for you, our listener? The article suggests having a buy list ready, especially if we see a summer pullback.
Right. The core idea seems to be, don't just react to the headline Fed cuts rates with fear based on, say, 2008. Understand the economic context. If the economy is holding up, history, according to this analysis, suggests it could actually be a very positive signal, particularly for smaller companies.
It's about looking beyond the surface noise.
Exactly. And the source mentions their own tools, like Outlier 20 reports, for finding stocks with repeated buying, and they highlight specific nuclear and AI plays for their members. Things seeing inflows and having strong map scores.
Which their internal rating system, right?
Yeah, they're proprietary scored based on technicals and fundamentals, signaling strength.
Okay, wow. That was quite a deep dive. We've covered the market's current broadening boom, the potential boost for small caps from Fed cuts, and this crucial historical context distinguishing different rate cut environments.
And the big takeaway, I think, is just how vital that context is. A single event, like a rate cut, can mean very different things depending on the surrounding economic health.
Yeah.
Ignoring that nuance means potentially missing opportunities or misjudging risks.
So for you listening, maybe the question is, how does digging into this kind of nuance, beyond just the headlines, change how you view what might be coming next? It's about understanding the gears turning underneath.
Well said.
Thanks for joining us on this deep dive. Hope you feel a bit more informed and maybe have some new avenues to explore.